All right. You are listening to Avery's Around the Desk podcast, where we dig into markets, companies, and ideas shaping what is coming next. I'm Sean Emory, Chief Investment Officer, founder here at Avery Co. This conversation is for informational purposes only and should not be considered investment advice. We may hold positions in some of the companies discussed here. Please do your own research. You know this before making any investment decisions. Today I wanted to talk about, what feels disconnected. Macro is stabilizing, something we have been discussing, somewhat predicting if you read our annual letter. Earnings are holding up. Again, something we have been talking about. Now, here I set the tone, right, where we wanted to show Jensen Huang, saying, the CEO, obviously, and founder of NVIDIA, basically highlighting this week that, the software sell-off is the most illogical thing in the world. It's a strong statement. He didn't have to say that, but if you think about it, and you believe in, the AI build out, which we do, if you believe compute demand is exploding, which it is, if you believe NVIDIA's GPUs are going to be, sold at historic levels, which they are, then I think you have to believe that software demand is going to increase and increase meaningfully. Compute in itself does not exist in a vacuum. So AI needs really orchestration layers, workflow layers, data platforms for context. It needs application layers. Again, you cannot believe in AI infrastructure and not believe in expanding, software usage more broadly. That may aggregate to several names. And that is part of the view as well. And I will highlight to you, here why at least we here at Avery are well positioned for that extreme scenario. But I do think, the contradiction of, Jensen saying this versus what's happening and some others that are, pretty prominent, in the space. So, but let's start real quick, and highlight, some of the stability that's happening out there. So here we're looking at inflation. If we zoom out, CPI came roughly in line with, expectations. It's right around, 2 to 3%. And, it's kind of stayed in this, mid 2 range for quite some time. Now, if we look at trueflation, which is a more real-time reading, that's closer to 0.7. And that incorporates like a, real-time shelter, which continues to be, a burden in CPI. But either way, I think both of these say the same thing, that inflation, is cooling. For another discussion is, the administration announced that, tariffs, in different countries could come down. So there's news of that, which would only add fuel to the, deflationary, or inflation easing further. AI-driven productivity as well as deflationary. And then obviously supply chains are pretty normal these days. But, anything can flare that up. But overall, I think the inflation story looks very, very contained. And that should be a strong signal as we expect, more and more rate cuts this year. Now, the break-evens also have, shared this. So this looks at break-evens. And basically, it's just a signal of what the market expects for inflation. You saw it perk up, at the end of 2025 and then, come down and then rise in, early 26 and here recently start to come back down. So I think that's good news. So inflation risk, I think, is, very much of the past, and it should be seen as much of the past. Jobs is kind of the second stool that I think a lot of people negative have held their hat on. Our view has been, 2026, we're actually more likely to see a reacceleration in growth than a collapsing growth. That's kind of contrarian to the narrative. And, this week we saw 100 and, roughly 170,000 jobs added. And that's not explosive, but it's well above, what estimates were. And, we're not going back to 300,000 jobs. We're not coming out of, some crazy crisis like, 2020. And, ultimately, I think what we're seeing here now is that jobs will likely start to pick up, going forward over the next, couple quarters. And that'll be further evidence that, we have a pretty stable, jobs market. Now, two indicators that I wanted to focus on were really around, hourly wages and also the hours worked. Hourly wages, 3.7%, continues to hover around there. It's a good thing. Again, if we're talking about inflation, the price of goods and services at 2.7 or 0.7 in real time, 3.7 is above that. So people are making money faster than the prices of goods and services going up. So that's important. again, hours work. That's where you'll usually see, the early indications of a labor market that's going to roll over. Usually before you fire, you just have people work less hours. And that actually ticked up and is at the highest level, it's been. Here we're looking at something that I think is important and also is counter to, much of the, AI is displacing this or AI is displacing that, prime age labor force participation. So these are 25, 54-year-olds, highest since the early 2000s. So if AI were, massively displacing workers, you'd probably see weakness here first. And again, the narrative is kind of counter to that. So it's kind of strange where, again, we have, some of the highest participation rate for, this cohort of users or citizens, civilians, and ultimately, the narrative is quite the opposite. This one's cool. So, we're using, AI to analyze within S&P 500 transcripts, how many companies are talking about layoffs. And you could see that spiked in 2022 and has since come down. That's the white line here. So that has since come down. And, the green is just isolating for information technology. So again, our belief is, if we're going to see layoffs, it's more likely to come in the form of from technology, given that they are the enablers of tech. They know how to use software and AI. So in theory, they would be the ones displacing. I know there was, Amazon, getting rid of 16,000 people, but if you go on, their job openings, they're hiring 20,000. So again, I think headlines versus reality is real. So let's go into some earnings, this week. Zillow, housing market's flat. Zillow grew 16%. For me, that's good. Rentals are growing 45%, mortgages growing, north of 40%. Monthly active users, I'll show here on the next page, 221, growing 8%. So, user growth is accelerating. If AI were even, I don't even know how they got thrown into the mix. And you'll see later that, real estate names got thrown into an AI mix. But they're seeing, many of the things that you look for in a good business. So growing across the board. Maybe the most important takeaway from, this slide is that, growth is coming not only from residential, but from rentals and also mortgage. So that's really good. This shows the active users. You can see that growth, hitting 8%, which is some of the strongest growth they've seen. It's very hard to replicate 221 million monthly active users, growing 8%. Very few companies have that amount of reach, and growing that fast. So more evidence and supporting evidence of, one of the reasons why us here at Avery, invest in that despite some of the volatility here. So we're big believers. Again, not investment advice. Here's Airbnb, and it's interesting. They're growing double digits globally. Latin America strong, rest of the world strong, North America stable. Chesky, CEO, founder on the call said AI is an enabler of speed for their business. So again, I think marketplaces like Zillow, other marketplaces that are out there, some could be exposed, but when you're that big, that broad, and that important, I think ultimately what we're seeing is, automation and AI assisting as opposed to being a hindrance. And it's not showing up in any of the numbers, and ChatGPT's been around since 2022. So let's get into like the AI scare trade. There's headlines like this, right? We saw real estate brokerages get hit. We saw financial services get hit. We saw freight, literally, trains and planes, get hit. Even kind of like, the tiniest announcement from obscure companies were triggering, strange moves in different places. And, that's the state of the market from a, trading every single headline. And, here we're looking at the, just a headline on Bloomberg showing, real estate stocks, things like Jones Lang, LaSalle, CBRE, Cushman and Wakeman, falling 15% on news that AI could displace them. Here's the highlight that shows, some of these financial services stocks like Charles Schwab down like 25% in a couple days on a AI tax planning announcement from another company. And, we don't invest in any of these companies here, but ultimately I do think this is just signal that, some of the stuff is indiscriminate. And, many of these things, our view is, and again, not recommendation, is, many of this stuff will bounce back in due time, even though, again, we don't own any of these that you see on the page. This is the freight logistics. So a tiny company announced, something they're doing with AI, and that hit, almost like physically, physical companies to some degree, freight, forwarders. And, many of these companies were down double digits on that news. So again, more evidence. This just highlights, the various different categories that have gotten hit. And I think, look, AI is going to stay with us. AI is not going away. So the question there for us is, a couple things. Are we going to, one, is it obviously an opportunity? Number one, what is our views on it? Number two, and we shared an article today from ourselves with data supporting some of this. But look, here's Tama Bravo, Orlando Bravo from Tama Bravo, just articulating that, the companies are really, really cheap in the software space. That most of this stuff is illogical or not logical. And then also, Jensen saying the same thing. And there's many others that I could have put on this page saying the same stuff. Here's a good way to frame it as well. So here's Block, and you can see in white up there is the bonds for Block. So if people were really concerned, there's an old adage out there that bond investors think with their head, and equity investors, think with their heart to some degree, and they're very emotional day to day, and you see that in price action all the time. All the examples I showed above, but here's looking at Block's bonds, which have not gone anywhere. If there was real credit risk, financial risk to the companies, usually you would see the credit markets, the bonds of these companies, feel pressure. And you haven't seen any of that in the stocks in the world, and many of these I showed, like ServiceNow and Salesforce and Block and some others, the equities, being volatile while the bonds themselves not. And again, it just shows, a dislocation or a disconnect between the financials and the well-beings of these companies versus, movements. Now, this is interesting, right? So let's assume that the view that AI is going to eat all of software. I can draw the line between that happening, right? And if that does happen, let's think through who's going to win. And so let's say everything migrates to the AI labs. You have OpenAI, you have Anthropic. Anthropic is, the owner of Claude Code, and, many of the other, models and different products that they continue to announce here. So Zoom made a $51 million investment in Anthropic in 2023. That investment is now worth somewhere around, 2 to 4 billion. So 3 billion at the midpoint, let's say. This week, Anthropic had a $380 billion raise or valuation. There's views that they can go out this year at around $1 trillion. And, we just summarize. We say, okay, look, let's assume AI eats all software. Let's assume value accrues almost entirely to the model layer. Let's assume a duopoly, OpenAI, Anthropic, similar to Airbus and Boeing, similar to, Apple and Google, similar to many different ecosystems that are out there that are infrastructure. So everything accrues to them. If knowledge work, plus software economics, represents somewhere around tens of trillions of value in the US, then model providers could, theoretically, justify, multi-trillion-dollar valuations. Again, we're already talking about, potentially $1 trillion this year for Anthropic, and same for OpenAI. But they would be worth more than, the compute layer. And therefore, we assume that they reach, $20 trillion of market value in a duopoly. So it's 50-50 each. So 10 trillion for somebody like Anthropic. That would then suggest that the value of Zoom's Anthropic investment stake alone would be, north of $100 billion. Adjusted for, dilution, and some of the nuances will matter, to get to that value. But that'd be worth, 10x or more of Zoom's current value. So in a scenario where AI eats everything, and keep in mind, we don't own only AI, only software. So like we own restaurants, we own, a car wash, we own some other things that I think are much more immune, and, we're not even talking about here. But if we do assume and use that logic of AI eats everything, then that scenario, our company, Zoom would, with a 20% stake, would generate 200% returns to the portfolio. So pretty important. Again, markets are not pricing, that asymmetry, I think, properly. probably why Zoom has been the only software stock up for the year. But, again, I think, these aren't a recommendation, but I think in the world where you draw the linear extrapolation of AI eating everything, they are well positioned from that logic. They also have an investment in CoreWeave and Perplexity, which are two, big AI companies as well. So next page here is just showing, Ramp, which shows the amount of credit card spend happening on these different model platforms. And you can just see the acceleration that Anthropic's seeing. So good for them, good for Zoom. On this next page here, we highlight, and this is important, what could change the narrative for some of these things. Shoot first, ask questions later. But I think there's a couple different, things that can happen. CapEx moderates. I don't think that's too far off, actually. $650 billion is what the hyperscalers are spending on CapEx this year, and they've committed to. The market doesn't necessarily love that because there's no clean ROI except for Meta, which again is a holding in our company, which there's no clean ROI as much for some of the others. And, at $650 billion, the market, again, doesn't love it. And, we saw in 2022, 2023, the years of efficiency where the market, batted an eye, and then the companies themselves reined in some of their spending. I'm not saying CapEx, goes negative and we go the other way. It's that seeing a peak level of CapEx growth would send a signal that we're cresting in terms of growth rates for CapEx. And I think that's an important signal that I actually do think will happen in 2026. When? Who knows? But the second one is valuation reset that creates enough support where people, a lot of, again, when things happen in the market, they tend to happen fast. People extrapolate a point of view all the way into the future, as opposed to, applying any sort of logic to it sometimes. We've seen that time and time again, whether it was COVID or other, times as well. And ultimately, the importance here is that, valuations reset and create support. So valuation support. The next is retention. So seeing companies, really software companies, and some of the other companies that are getting hit that aren't even like truly software, showing retention gains, showing, AI revenue coming from maybe new modules. So you're seeing and hearing some of that, and I'll share some of that. Buybacks. So companies, many of these software companies, haven't even reported yet, and therefore they can't even buy back their shares during some of the turmoil. And that has been acting as a level of support over the years. So, it's kind of been this gap. So I assume over the next, month, 30 days, 45 days, as they all report, opens those windows back up. Number 5, I think, is a real reality in 2026 where you get a scare around, things like prompt injection. So really like cyber malicious activity happening with these AI tools that I think could prompt enterprises to slow down, their rate of adoption to some degree. Again, look, I'm a big believer in AI. We use it internally. It's a big thing for us. I think more and more AI is going to be used and surrounding on us, but I'm just outlining that, that we're probably going to have more software, not less software. And in that case, that you do have a scenario where AI eats everything, those that own the model layer, I think will eventually, all that value in theory in that worst case scenario would accrue to them and we would be just fine. Number 6 is macro stability. You obviously need macro to continue so that the narratives don't cross, that job losses or job strength, obviously, is not from a macro event as opposed to, AI displacing labor. And so that's kind of some of that. Now, what are we seeing? So here's a good visual in blue earnings for, the software index and price in white. And you can just see how that is disconnected. Here you can then see prime books. This is looking at Goldman Sachs and looking at the amount of the percent weight and net exposures that, funds have to different areas. So they're max overweight. I mean, in theory, they could go more max overweight for semiconductors, and they're, they're on record underweight to software. So you saw that happen fast. So again, positioning matters as, at some point you get to a camp where there's the long only community, the people that are buying these things for, 3, 5, 10 years and really buy and hold are owning these things and not necessarily net sellers. So as long as you flush out, many of the net sellers, the panic sellers that, were maybe in it for a trade or skeptical about the future, those get out, and then you eventually have, buybacks and, your core long only. And then you start building back up. Here's showing some of the companies this week alone and last week as well that highlighted retention going up, highlighting, either a beat and raise for the full year, highlighting that things are rather stable. We need more of that from many of these companies. Again, many of them haven't reported yet. So I think as the year goes on, that will be part of it as well. So that's really that. Again, really just to summarize is there's a big disconnect, earnings versus price, EPS trending up, prices trending, down in some cases. If you own Zoom, obviously, I think you're protected for that worst case optionality of frontier tech just totally, AI taking everything. But again, the combination of valuations reset, positioning washed out, fundamentals pretty stable, I think ultimately is great. Look, in closing, AI is transformative. We're not dismissing that. We use it daily. Again, we believe AI is, ultimately infrastructure. It's the internet that many of these companies are going to build on top of. And we think ultimately it drives productivity. We'll have more software, not less. And I think that is a contrarian view. You're hearing that from many that are on there. So anyways, we'll end there. We'll be back next week with another update. If you want to reach us, feel free to email the team. And as always, follow us on X, on LinkedIn. We post additional insights there throughout the week. With that, have a good weekend.